So there's been another increase to the base rate of interest as set by the Bank of England on the 22nd of September 2022. The majority of them voted to increase it from 1.75 to 2.25. So another 0.5 percentage point increase. There was sort of widely predicted that it might go up even higher to 2.5%, but the split of the committee was that 5 voted for the increase we got, 3 voted for that larger increase, and 1 actually voted for a smaller 0.25 percentage point increase. So normally it's kind of a bit more evenly split. This one, 3 different kind of possibilities that could have been the action. But again, 2.25%. This is again the highest rate we've seen in 17 years. What does this mean for your savings, for your mortgage, for your borrowing? I'll come to that in a second. But first, a little bit more about what the meeting minutes say, so you don't have to look at them. First of all, the Bank of England say that we are now already in recession. They predicted it might happen later this year. But because of the Queen's death and lots of things shutting for the bank holiday and the funeral, it actually meant that growth slowed down. In fact, it was negative for this quarter. That means we've had 2 quarters of negative growth, which means we are in recession. We're already there, apparently. That will be confirmed, obviously, later on, but that's their prediction. We're already in recession. The other things they talked about, well, inflation. Their meeting 6 weeks ago in August, they said they thought inflation would get to 11% this autumn. We're already just under 10%. They say but because of the new energy price freeze cap. If you don't know much about that, I have got a video you can check out up here. When that comes into play on the 1st of October, it means inflation probably won't go above 11%. And some people said that was conservative. Some people were saying it could have gone above 13%, even higher than that next year. They're now saying, well, it's still going to remain high. It's still going to remain around 10% for the rest of this year and maybe sort of coming down afterwards. But even so, that has made an impact on what they're saying. So maybe inflation won't be as high as we're predicting, but it's still going to be, say, very, very high. Bank of England wants inflation at 2%, and that is partially why they are putting in these increases to the base rate to try and control that. Although, you know, I'm not an economist, you're not an economist, but there's not necessarily a normal inflationary period right now. Things that are affecting it, like the war in Ukraine, therefore affecting oil prices. That's not something that you can really do anything about through monetary policy. But anyway, that is what they're saying there. But the interesting thing here as well is that the prediction of where interest rates could go next year have really, really shot up. And they have their own predictions, but they also talk to the markets. They do analyse what other people are doing out there, what's going on. A lot of this is already priced into that already. They're saying it could well hit nearly 5% next year. 4.8% is potentially the higher end of those predictions. Could be lower, it could be around sort of 3.5%, but it could go up to 4.8%. That's a massive, massive jump on what we saw predicted just 6 weeks ago. So again, take these things with a pinch of salt. As long as I've been covering these interest rate announcements, they say it's definitely going to happen like this, and then it doesn't, and nothing happens, or it's lower, or it's bigger, who knows. But again, just worth bearing this in mind. And let's actually talk now about what this means for your mortgage savings and other sort of borrowings. And let's start with mortgages, because as I keep saying when I do these videos, if you do have a variable rate mortgage right now, you need to get off it. You need to get onto a fixed deal of some kind, because the variable rate mortgages, not only are they likely to be the most expensive ones, they change as soon as the base rate changes, pretty much, more or less. Which means if you're on one, it's going to be more expensive straight away. But again, another sort of 0.5 percentage point. Remember, in December last year, so just 9 months ago, the base rate was 0.1%. So we're up 2.15%. That's a big increase. That's a massive amount extra on your mortgage. And if these predictions are true, and we do see more increases happening over the next sort of 9 months, if maybe longer, who knows, they're going to get higher and higher and higher. So get in, try and lock into a mortgage deal. And similarly, if you're on a fixed deal right now, which is due to end in the next 3 to 6 months, then hopefully you'll be able to lock in at one of the deals that are available now. You don't have to wait for that fix to finish for you to look for a new deal. How long in advance you can get that deal kind of agreed does depend on the mortgage provider, but generally a lot of places will allow you up to 6 months. And sometimes you can even do it with your existing provider. They might let you do it 3 to 6 months as well. And that sometimes can be a little bit easier because you don't have to go through all the affordability checks that you would by going to a different provider. But again, see what's available right now. The best deals are nowhere near where they were a year ago. Well off that, but absolutely really, really vital that you do look at this, because all that extra money coming off your mortgage, that's going to be really hard to deal with when all the other costs are increasing. Remember, the energy bills are still going to be going up. They're still increasing, maybe not as much as predicted thanks to this price cap, but they're still going to be higher, and other costs are still going to be higher as well. So you don't want all those extra mortgage costs if you can avoid them. When it comes to other borrowing, obviously, if you have got a loan right now, that's not going to change. But you possibly might see that the rates available if you're trying to get a loan increasing. Similarly with credit cards, we've seen a few of the credit card providers over time increase the rate on their credit cards. But as I say to all of you, if you can possibly avoid using a credit card for spending when you don't have the money, then please try and do that. This is because obviously the interest rate that you get charged there is going to cost you a huge amount. And if that does get higher, then you'll be paying more back. Ideally, you'll be paying it off in full. If you do have a credit card debt that you need to try and clear, look at those 0% money balance transfer deals, or potentially a 0% money transfer deal, which is slightly different. That's quite good for overdrafts and catalog debts and things like that. Those ones is potentially, you don't know about for sure about this, but it could well be that the length of those deals will get shorter or the transfer fee will get higher. So again, if you do have a debt on there on a credit card, do look at those offers right now, because it could be they disappear, not just with this increase, but if we do get those predicted future increases as well. Now, let's quickly touch on savings, because I know a lot of you guys following the channel are very keen to get that best possible rate. And obviously, this is the flip side of the increased interest rates. Well, at some point, if not immediately, those interest rates will increase on your savings. Now, it could be that we've seen a fair bit of movement, particularly in one-year fixes recently, that this increase today that we've seen has already been priced into that. So it might be that we don't see another increase or massive increases on those one-year fixes, for example, until maybe they start predicting what's going to happen in the next meeting in 6 weeks' time. Similarly, with those easy access accounts. Already, we've seen Marcus increase their rate from 1.5% to 1.8%. So obviously you can see that's not the full 0.5 percentage point increase, it's only 0.3%. So they're not passing all of it on, but they're passing it on to 1.8, which sounds fantastic from 1.5. But the best rate was already 2.1%. Now only one place was offering that and the next one was 2%. But it just shows you people are moving this up. They're not necessarily moving up beyond those top of the table. What remains to be seen, or what we keep an eye on, obviously in my monthly savings update video that I do, I will let you know when these happen, will be whether places like Chase and Virgin Money, who have tried over the last sort of year and a bit to be the market leader on easy access rates, they've fallen behind in the last few months. We're interested to see whether they actually go, right, do you know what, we're going to whack on this increase and maybe a little bit more, who knows, to try and be at the top of the table again, and significantly at the top of the table again, rather than just a little bit, because if they're just a little bit, it doesn't take much for another provider to maybe jump above them again. But again, I wouldn't expect, it's hard to say with these things, maybe one of them will go, rabbit out of the hat, we're going to do something straight away and jump up there. Others might take a bit of time to kind of bring this through. So there you go, quick summary of what has been going on today with the Bank of England base rate increase. I'll do another one of these in 6 weeks' time. Plus, as I mentioned, there's other savings updates, all the other videos I do on here. We are expecting a mini budget to happen from the new government tomorrow. So I will do another video telling you what's going on there, exactly how that will impact you as well. That's one of the reasons why, as I said, that the meeting today, they maybe didn't go for that 4.75 percentage point increase and just a slightly lower one. Hit the subscribe button so you get all those videos as soon as they come through. My name is Andy Webb. Thank you so much for watching. Check out these videos here for more to help you with your finances.